Hello everyone, welcome to my channel. This is Easy Accounting channel. Today we are going to continue on our IFRS 4 International Financial Reporting Standard 4 on insurance contracts. So the introduction. IFRS 4, the insurance contracts, applies with limited exemption to all insurance contracts, including the entity that issued the contract and the reinsurance contracts. So the standard provide exemption from some of these IFRS like IAS 8, accounting policy, changes in accounting estimates and error. And also this IFRS was issued in March 2004 and it applies till January 2005, and therefore it will be replaced by 2023 by IFRS 17. So IFRS 4 is the first guidance from the IASB, that is International Accounting Standard Board, on accounting for insurance. But this is not the last IFRS 4 that will be issued. So a comprehensive project on insurance contract is on the way, because it's going to be replaced by January 1st, 2023. So IFRS 4 apply virtually to all insurance contracts, including the reinsurance contract that the entity owns, as well as the reinsurance contract that it holds. It does not apply to assets and liability, such as the financial assets or the financial liability of the company. So IAS 39, financial instruments, recognize and measurement, does not apply to it. However, if an insurer of financial guarantee contract has previously ascertained explicitly that it regards such contract, then it has to be implicated. Now let's talk about the definition of insurance. So insurance is a contract which one party accepts significant insurance risk from another party to compensate the policy holder in case of uncertain future, like if there is any disaster, natural disaster, fire, flood, tornadoes. That is why the company will get compensation. So let's talk about the accounting policy for this IFRS 4, the insurance contract. So IFRS 4 exempts some insurance, and also IAS 4 accounting policy and changes in accounting estimate for the insurance also prohibits some requirements for this IFRS 4. Like number 1, it prohibits provision for possible claim under the contract that are not in existence at that date of reporting the issue. And also it requires a test for adequate of recognition of the insurance liability and the need for impairment test. And lastly, it requires an insurer, that is the company, to keep insurance liability in the balance sheet until they are discharged or cancelled or expired. Now let's talk about the accounting policy for IFRS 4. So accounting policy, it permits an insurance to change the accounting policy for the insurance contract only if as a result of financial statements. So that is the accounting policy that is applicable to IFRS 4. Number 1, measuring the insurance liability on an undisclosed basis. 2, measuring the contract rights to future investment and management fee at an amount that exceeds their fair value. And lastly, using non-uniform accounting policy for the insurance liability of the subsidiary. Now we talk about prudence for the insurance, IFRS 4. So an insurance, the company should measure its insurance contract with sufficient prudence. This does not change the accounting policy. It must be careful in measuring the total value of the risk that is attributable to the events. And also we talk about the disclosure, information that help users to understand the amount in the financial statement that arise from the insurance. So the accounting policy for the insurance contract that related to the assets, the liability and income must be disclosed in the financial statements. Also, the insurance is a cedant, and certain disclosure have to be required. Also, information about the assumption that have the greatest effects on the measurement of the asset must be disclosed, and also the effect of changes in assumption, and also reconciliation of the changes in the insurance liability must be disclosed. So information that will help the users to evaluate the nature and the extent of the risk from the insurance contract. So the risk management objective and the policy, those terms and conditions of the insurance that have a material effect on the amount, and also the information about the insurance risk, including the sensitivity of the insurance, the concentration of the insurance risk, and the actual claim compared with the previous estimates. And the information about the credit risk, liquidity risk, the market risks must be disclosed to the users. Thank you for coming to my channel. I hope to see you in my next video. Please subscribe to my channel. Thank you. Bye.